Seshadri Sen, Head of Research and Strategist at Emkay Global Financial Services, joining in to talk about exactly that. Seshadri, hi, morning. Great to have you today on ET Now. Seshadri, can't get your eyes off from IT and the damage that one has seen after Accenture's performance onto IT. I mean, there was in any case such a significant derating, both price as well as valuation-wise, but it seems like a bottomless pit now. What is the call to the investors?
Yeah, meaning IT continues to get cheaper because the narrative that that AI is structurally damaging to the sector is just not going away, and the results that come from the companies are not wishing that are doing nothing to dispel that fear among investors. Broadly, if you take the longer term, I think some of these fears are clearly overdone. I don't think that AI is going to wipe out the IT services companies. And to be fair, the Accenture numbers, there was, I don't think there's going to be a great deal of consensus earnings downgrades, and their cut in guidance is fairly marginal, right? The midpoint is down just 50 basis points. But there is the narrative will continue as long as things settle down and there's greater clarity. But 2 or 3 months ago, I spent quite a bit of time speaking to practitioners across the IT ecosystem, from end users to startups. There is a lack of clarity, but and there is no doubt that there will be some damage done to legacy businesses of India, of IT services companies. But in the longer term, I think the broader expectation is that one, the relevance of IT services companies will not go away, and two, there is a chance that as AI makes building software cheaper, there will be a surge in spending by companies to adapt to the new reality. But for the moment, if you take the next 3 to 6 months, we've been slightly underweight on IT. We've not gone to zero, but slightly underweight. We would stay that because there are no triggers in the next 3 to 6 months for the sector to re-rate. In an absolute level, I think the valuations are not that are obviously quite attractive. I think most of them are trading at implied growth multiples, which are now turning zero to slightly negative. And very high free cash flow yields. But in the next 3 to 6 months, I don't see a clear trigger for a re-rating.
Seshadri, just a quick follow-up on IT before I ask you, and a quick one. You suggested at the start of your earlier response that a de-rating is warranted. At the end, you said largely over. So is this a good time to probably start to nibble on if you're a slightly longish time investor, maybe 12 months, 18 months horizon? Is this a good tactical buy at this point?
Not tactical, but if you're willing to live through short-term pain, then yes, it is because one can never catch the bottom. That's not something that an investor should aspire to. And but I think next to 3 to 6 months at least, there will be pain. But if you're looking from not even 12 to 18 months, from say 18 to 24-month perspective, this is a good time to buy, because I don't see the sector getting wiped out as the valuations seem to imply.
Time to buy. Okay. And Seshadri, the other piece which is playing out, and you have a great hold on macro as well as the BFSI space, right? So coming from there, give us a sense as to what the rains mean, what the lower monsoon, likely to be meaningfully lower, means for the sector, which is the financial sector, because it's a consensus buy. The only possible risk is growth coming off, and one of those risks is the weather.
The weather has implications for sectors beyond financials. So let me break it down in terms of what the weak monsoons mean. First, inflation, but we do believe that there are enough buffer stocks, and for the if last 7-8 years, if you've seen the El Nino years, the policymakers have managed to keep a lid on inflation. You're not going to see inflation go up to 8, 9, 10%. There may be a slight spike. And most likely the RBI will see through that supply side shock-led inflation. And therefore, I think the overall impact of inflation will not be that severe, even if there is a weak monsoon. The second is on rural incomes. That is certainly a worry. But if you look at the larger consumption basket, the dependence on rural and agriculture income is coming down with every passing year. So there will be pockets where you will see a demand slowdown, a little bit of a negative surprise on growth as in the consumer basket. But that's, you'll have to go out, figure out stock by stock. For the larger universe, it is dependent more on urban income and higher non-agricultural and urban income. So I don't think that there's going to be a bit of a shock, but there will be a sticker shock impact. As we are right now, and of course we in Mumbai are facing the brunt of a very weak monsoon. So as long as that continues, there will be a sticker shock impact, and that may cap the near-term upside for the broader markets. But if you take even a 6 to 9 month view, I think the markets will look through the weaker monsoon, and we won't be discussing it maybe 3 or 4 months down the line.
That's the nature of the beast, isn't it, Seshadri? It all falls well as you look back. But tell me, how is it that one should position their portfolios right now? Where is it that you would recommend overweights, given that you're so confident market will not see a very huge reaction to a bleak monsoon?
So our key overweights are consumption, more on the discretionary side, and industrials. Those are the two key overweights that we have coming out of in the post-war situation, and in a where supply chain concerns or raw material price inflation, those worries are largely addressed. Those are my key overweights, and within those, we continue to like internet companies. That's a theme that we remain very positive about. And within financials, the small and mid-cap financials, which have seen a wave of FDIs coming in, those stocks we think are the valuations are on the right side. The new capital gives them a runway of growth that that are not captured yet in the valuation. So those are the couple of themes that we like. And in terms of long-term overweights, we like consumption and industrials. And of course, tactically, the post-war trades are still in play. So things like OMCs, cement, etc. Some of those post-war bounces, I think, are not fully done.
Very interesting. Okay. Seshadri, two things which are weighed down on Indian markets, especially on the Nifty. Maybe not on the broader market sentiment. Mid-cap, small caps have been relatively better off. Choppy, but better off. Earnings and flows, right? Both of them have been big headwinds over the last year and a half to 2 years. You believe both of them will unwind FY27 to a large extent?
Earnings for sure. You see, through this entire 3 months of the Middle East conflict, earnings forecasts have stayed steadfast, largely because financials, which is a large part of Nifty earnings, is set to recover very sharply because of the peculiarities of the rate cycle. When rates stabilize, asset yields start to be repricing is upfront, and then with a lag, deposit repricing kicks in, margin improvement, asset quality is good. So with strong support from financials, we think Nifty earnings is broadly stable. We look at some other metrics. We look at the top 500 companies and see the dispersion of growth. And there also we see that the share of companies which are delivering 25% plus growth goes up from 31% in FY26 to 41% in FY27. If that kind of forecasts hold, and we have a reason to believe, because we think now that the headwinds from the Middle East geopolitics is done, we will see a resumption of consumption growth. Then I think the earnings will, not just the Nifty earnings, but broad-based earnings will do well, which is why we are seeing the outperformance of small and mid cap in this rally over the large caps. So that remains earnings will. As far as flows are concerned, there were 3 or 4 worries from foreign investors. The first is the currency, which I think is largely addressed, especially if the FCNR and the other schemes are successful, then I think the currency is seen its worst, and from here you're going to be a stable to an appreciating currency. Second was that India was a slightly expensive market with no earnings growth, so at least the earnings growth will come through. The third is that India is not part of the AI narrative, and in some ways seem to be a victim of the AI narrative. We're seeing that in the tech sector today. That is not going away. So I'm not sure that flows will come back in a rush at this point in time. For that, the global narrative has to change from AI definitively, which is very difficult to predict at this point in time. But at least I think the selling will stop. The kind of massive selling that we've seen in the first 5-6 months of the year, that should abate now that the war is done and the currency is stabilized. Domestic flows aren't going anywhere. They will continue to come into the market. So from a flows perspective, it should marginally better, but I think it's a little too early to predict whether the FIs come back buying India in a big way.
So, Seshadri, where does it leave the RBI then? What can we anticipate for them in terms of rate moves?
I think the RBI will stay on an extended pause from here. There is no reason to cut. They've cut very aggressively, and it's time for them to wait to see how those cuts pan out, translating into higher consumption and investment growth. And the more important part is how does liquidity play out? Because of the pressure on the rupee, liquidity has not been, if you've seen, the marginal, wholesale deposit costs have been pretty hard over the last 3-4 months. But now with all the rupee defense measures and the fact that the war is over and the currency is not under that much pressure, the defense is not needed, I think domestic liquidity should go back to slightly higher levels, and then that will aid transmission. So the next 6 to 9 months is more about transmission than about actual rate cuts. I think the RBI stays on hold for the time being.
Okay. Seshadri, thank you so much for coming and speaking to us and giving us that perspective. Always good having you.
Thank you so much for